Today, we're going to be talking about ESG options, investment options. Today is Paul Merriman's opportunity to explain exactly what ESG means. But before he does that, I'd like to make a couple of opening remarks. First, I want to say that Paul's presentation is made possible both by the Merriman Financial Education Foundation, which is an organization that Paul founded to share the knowledge and wisdom that he himself gained for years as a financial advisor and the founder of Seattle-based Merriman Wealth Management. It's also part of a series that was created with the Bainbridge Community Foundation, and they have several more talks coming up this spring, including some that include Paul. You can learn more by going to the news and events button on the Community Foundation website, and that URL is Bainbridge CF, Bainbridge Community Foundation, bainbridgecf.org. You will hear from, as I said, Paul and Tom Cock and Christine Benz and Mary Beth Franklin. And the topics cover investment for people of every age. And I also wanted to mention that our online and lecture program, Something to Talk About, what you're watching right now, is supported by Fieldstone Communities of Bainbridge Island. To learn more about their memory care, assisted living, and independent living options on Rolling Bay, call 360-689-4314. And I really want to thank you, Paul, for taking the time to present for us. We have had many seniors who have really appreciated your sharing of your wealth of knowledge, pun intended.
That's good. Thank you, Reed. That's very generous. I really am excited to be back. And you came up with this idea. You asked for it, and when you first asked me for it, I stumbled a little bit because I actually personally do not have any money in ESG mutual funds or ETFs. And that is not because I don't think they're a great investment. I think as you follow my comments, you will discover that I think it is maybe one of the finest investments that a lot of people will ever make. And I'll explain why. And by the way, before I do that, I want to follow up on your comment about the work that I'm doing. I want to make sure people know we have an amazing group of volunteers, people who have been around the investment community for a long time and have brought a wealth of knowledge to us and to our followers. And it isn't just all about my work. And I do want to mention that, Chris, you mentioned that Christine Benz is going to be here next month for this presentation on Zoom. And I just got to tell you, I saw this presentation at a conference in Arizona just a few weeks ago. And afterwards, I went up and I said, boy, if you could just do that for our folks, that would be beautiful. So she is bringing that particular presentation about taking distributions in retirement. I think people will really enjoy that, and other things that we'll be doing during that series. So investing in ESG, and I'm going to get my little pointer thing up here so that I can point to things when I need to. Hang on one sec. There we go. Our mission, our foundation. It is really about teaching people to take better care of their investments, make more money, take less risk, have less concern, worry, more peace of mind. And in the years that I built my own investment advisory firm, I would teach. I had 3- and 6-hour workshops. They were all free. At the end of those 2 workshops, my hope was that people could do it all on their own. And if they didn't want to, they could come to the firm that we were building to do it for them. Then when I retired and sold the firm in 2012, I gave up being an investment advisor and became purely a teacher. And so I have been teaching and writing and doing videos and podcasts since. And it's the availability of Zoom. How that has changed my life. I used to have to stand around a lot of airports, not anymore. Well, as I said, I have not been an ESG investor. We'll talk about what that is in a second, but I do think it's important to make it very clear what characteristics would you look for in any mutual fund, any ETF? What makes them the best? And from everything that I know, I think it is the expenses, it is the diversification, it is the low turnover, the minimizing of any expenses of managing that portfolio that leads to the best returns. And the thing is that if you can even get market returns, if you could make what the market itself gave without any of these expenses, you then would have had a tremendous return, because long-term studies have been done by SPIVA, Standard and Poor's organization. They've looked at 20-year periods, and about 1 out of 10 mutual funds is able to do as well as the market itself. So I would like to know how to be in those mutual funds that perform as well as the market. And you're going to find out that is one of the challenges of the ESG funds. I have a list of what I consider to be the most trusted funds in America. Now, the reason I call them trusted is because people seem to be willing to put money in them and leave them there for a very long period of time. And it is that ability that separates the average investor, in most cases, from the superior investor, because it seems to be staying the course is not all that easy. And I've met over the years many people who started investing in index funds, even in the mid-70s when they were originally offered by John Bogle and Vanguard. And that's all they did for the rest of their career. And they became multimillionaires because they had the willingness to stay the course. So with that kind of trust, where do we see most of the money going? Well, we know the S&P 500 is a $32 trillion market. That's the value of those companies. If you looked at the total market index, it's a $40 trillion package of public companies. But these two are where most of the money is going to end up in retirement accounts and other accounts, educational accounts. They are very popular. Of course, they also represent the majority of public ownership, so it's not a surprise they're popular. Then there's the target date fund. It has, since it was introduced in the early 90s, become the #1 way for young people and older people to invest for retirement. And the reason they are so popular is because they allow a 21-year-old getting started to invest their money one time in a way that it will be managed by professionals from that day on, making adjustments as they go into their 30s and their 40s and their 50s to add bonds along the way, to take care of all of the diversification that's necessary, and to be willing to have the amount in equities in the early years that can be very difficult for young investors. So over 50% of the new money going into 401k plans in the US are in fact going into target date funds. So I call that trust. Now, there are good target date funds and there are bad target date funds. So there are some that I trust more, and it won't be a surprise before you're done to find out that those use index funds as the base of the underlying portfolio. Along then comes the ESG funds, environment, social, and governance funds, but they're not new at all. As a matter of fact, they've been around in some way or another since the 1800s. But this is truly the fastest growing segment of investments. And by 2025, they expect to have about 1/3 of all global assets under management will have this designation of ESG. It's not as common in the US as it is internationally. It is, I mean, I think it's double, even maybe triple the amount of money that's going in overseas. And all of these, whether it's the S&P 500, the total market, the target dates, or the ESG funds, all of them have the potential of being trusted for different reasons, for very different reasons. But they are the kind of trust that allows for the probability of continued ownership. And there is nothing more powerful than having trust in a diversified portfolio starting as early as you possibly can. I know that the people that will probably watch this this presentation will be older than people who are infants, certainly, but we just had a new infant, a new baby in our family, and we immediately funded that child's Roth, not in the Roth, but for the Roth, hopefully for the rest of their working career. And I believe, and that is why this is a faith-based industry, I believe that it will be an approach that will turn out to be very, very rewarding with very little left for that individual to do. And when I say this is a faith-based industry, it's not just the faith in these particular funds and the asset classes represented by those funds, but it is also that all of us who are working in the business, there's not one of us that knows what's going to happen. We cannot tell you the future. We usually, if you're in this industry, and I was in it for most of my career, when you're in this industry, you do have the belief that the good times are going to continue, not always, but along the way. So I just want to say that whenever I talk about the future, you know that I don't know. That's an important understanding. But I think there are reasonable assumptions we can make about mutual funds' long-term returns. For example, I think it is pretty easy from all the research to say that index funds do better than actively managed funds. And so you're going to find as you move into the EGS or ESG arena that you will have this choice of actively managed versus index funds. We believe that low expenses will do better than high cost mutual funds or ETFs. The same there. The lower costs reward the investor more. There are some kind of controversial subjects, and I won't go deep into this, but we also know that historically smaller companies have made larger returns than those of larger companies. And the academics will tell you that that's simply a matter of more risk. And as you follow the bouncing ball from bonds to stocks, more risk, from large companies to small companies, more risk, and from growth companies to value companies, more risk. So value funds and stocks are expected to outperform as a group the growth. And we also know when we talk about returns, it's not all good. There are going to be bad times. And I don't care whether we're talking ESG, S&P 500, small cap, large cap, value growth. There are going to be periods, in fact, historically, about 1 out of every 4 to 5 years, we're going to have a setback, a bear market, in fact, an average loss historically going back about 100 years of 30%. So that's part of the process as well. I do want to take a second and just highlight, as we talk about these, what are stock funds, equity funds, the ESG funds, that we are looking typically at this fork in the road between stability and growth. We look to fixed income. We look to bonds. We didn't feel that it was low risk last year. I'm sure many of you feel that way. But historically, if we look at all the years of good and bad markets, both with bonds and stocks, bonds are much less volatile. And you can see that right here over the last 94 years. The short-term government bond, STGB, and intermediate government bond and long-term government bond, $100 investment over the 94 years grew to somewhere between $2,000 and $16,000. Now, this table goes through 2021. I will tell you, and this is a really good lesson for all of us, The worst calendar year loss that we had ever seen in bonds since 1928 was a loss of 14.9%. Last year, the loss in long-term government bonds was twice that. So that kind of a surprise, unfortunately, is always built into the process of investing, which is the reason that I recommend people have more than enough, save and earn, and build a portfolio that is more than enough. A lot of people talk about you just need to have enough. Only reason I'm going for more than enough is because so often we run into these kinds of challenges that take what looked like a fairly easy home run in getting to where you wanted to be, only to find out that some kind of a catastrophic event happens. When you have more than enough, you have a better opportunity to stay the course when the bad times come. But I just want you to notice that $100, which grows to $2,000 to $16,000 in equities, and I'm talking looking at the 4 major US equity asset classes, because as you think about the ESG funds, you are going to want to, if you can, have some of these different asset classes. Now that's a challenge with ESG, and you're going to find out in a few minutes why that is. But here is the value of $100 in the S&P 500, over 900,000. Here's in large cap value. Value stocks, remember I said they historically do better than the growth, the popular companies. And there's a reason for that. It's real simple. People tend to at times, way overpay for those really good companies. They have expectations for the future that very often are not met. The dreams of Wall Street are many, but not all those dreams translate into success. And when they are not successful, it is those large growth companies and small growth companies that have a tendency to suffer the most pain. So large cap value, the 100 grows to 2 million. Small cap blend, these are companies that are both value and growth, but they are about 1/100th the size in terms of how big they are. The number of shares times the market price of their company creates the capital value. And so they're smaller companies. They're not penny stocks. They're legitimate companies. But notice that $100 grows to over 4 million, and small cap value, the gold ring of investment asset classes in the US, grew to over 13 million. And I'm not going to spend any time talking about this, but I just want you to notice that over here on the right, we have combinations of those 4, because you could build a portfolio. You could, in theory, even build an ESG portfolio using combinations of big and small and value and growth. So let's talk about what the ESG fund is all about. The idea is that the companies are doing good while they're doing well. And basically it has been, well, in the beginning, it was really a sense of getting rid, not allowing companies in a portfolio that represented things you didn't believe in, which historically tended to be alcohol, gambling, and tobacco. Now I'll mention tobacco a little later on, and the return on tobacco compared to the return on other things in our society. But the Pioneer Fund started in 1928, and that's what it did. It got rid of alcohol, gambling, and tobacco companies. And today there are several different ways of identifying these ESG funds, but basically it's a focus on the environment, on the social issues, and on the governance of these public corporations. And it's a focus on sustainability. Now, one of the interesting things is there are literally, it seems like, hundreds of ways to explain any one of these terms, because they are terms that in many cases are based on feelings. And so here's one sustainability definition, and that is meeting our own needs without compromising the ability of future generations to meet their own needs. Doing the right things to last forever. I guess that's what they're looking for these companies to be able to do. Now, I don't want you to think that everybody thinks this is a great idea. I've talked to people in the industry that I have great respect for, because since I've never actually owned an ESG fund, I just wanted to get some feedback from people that I know have been around, maybe not as long as I have, but they certainly know more than I have. And here's kind of just a little idea of what I heard from the critical side. And one is that it's a fad. Now, I have a hard time thinking that it is a fad, but I can tell you that the idea that somebody could see it that way, and that Wall Street is promoting this fad to gather assets and charge high expenses, well, let me tell you, a lot of them are doing that. It may be that ESG investing is not a fad. I don't believe that it is, but I do believe that Wall Street is on the hunt. And of course, they are going to offer you products that fit this ESG concept, but they're going to get fees that are way higher than what I would say you should want to expose your family's money to. And I love this comment from one person. He said, if you want to support a cause, but because in a sense, ESG investing is about a cause, a feeling that an investor has in what is the right thing for corporations to be doing to the folks that work for them and for their shareholders, et cetera. But that if you want to support a cause, invest in a low-cost market index fund, and he happened to say total market index fund, and give your favorite cause the excess returns you're likely to get. So that is another way of seeing how to use corporate America to help others. Let me look at the environmental factors that Vanguard mentions on their website. The air quality and emissions, the energy use and conservation, natural resources and land use, waste management, water quality, hazardous materials. Now, this is a relatively short list. When you looked at Vanguard's social factors they focused on, labor and employee relations and standards, production quality and safety, local community impact, equal employment opportunities, healthcare, education, and housing services. It's sounding very liberal, I would assume, and I suspect that you would find that the people who support these kinds of investments have those leanings. I have not seen a study, but I'm guessing that would be the way it could be. Then there's the Vanguard's comments on governance factors like business practices, how ethical are they, board independence and diversity. As a matter of fact, they even, when they rate these companies, they rate how many women do they have as directors, how many officers within the company, and then voting rights and executive pay versus employee pay. So it is this question of what is right, what is fair, and Morningstar, in their page that gives the quick overview, says investable food, water, energy, health, and community. A very simple view of a very complex industry. And by the way, Morningstar is one of the best known raters and evaluators of ESG companies and funds. And Fidelity, you can always count on Fidelity. I've been around the business since the mid-1960s, and Fidelity has been at the cutting edge of a lot of things during those years. One of the things they did in 1981 was come out with a whole family of sector funds. So they broke up even broke up industries, so you could buy pieces of industries. In the computer, you could be at the software end, you could be at the hardware end. Energy, several ways to be there, but they had dozens and dozens of these sector funds, and I can tell you, some of those funds have hit absolutely huge home runs. The healthcare sector fund, compounded since '81 at about 15% a year. The software sector at about 15% a year over all of this time. That is compared to 12% for the S&P 500 and about 14% for small cap value. And now they're doing the same thing with ESG funds. So they've got their Healthy Future Fund, their Climate Action Fund, their Water Sustainability Fund, Environmental Bond Fund, that's the only bond fund in the group, Women's Leadership Fund, a fund for environment and alternative energy. Now, this is just like Fidelity. They are one of the biggest because they have figured out how to appeal to people's interest in what could be viewed as sometimes fad funds. But I have a hunch that there will be people who will put money in these kinds of funds and will just leave it there for the long term, thinking that's the niche. That's where the greatest growth is going to be. So you can speculate in ESG just like you can speculate in regular sector funds. So how to select the best ESG funds? Well, it's going to start with what you believe in, what you want to focus on. Since I don't have any ESG funds in my portfolio, I asked, what kind would I probably want to be in? Well, if I am going to devote my investments to ESG, there's a suggestion there that I really care. I care enough probably to give up some return. We'll talk more about that. But I care enough to give up some return because it is a way of supporting the things I believe in. And if I made that kind of commitment, I would still want all the other things that I see in a good fund, the low expenses, the broad diversification, and high tax efficiency. I would like to have all of those things, but I think I would want to have a complete diversified portfolio of ESG companies. And I'll introduce you to a few of those companies that rate the ESG companies, because that's a big business now. Since there's so much money going into ESG funds, how do you know what a good ESG company is? So there are people who are paid to tell you which ones are the good ones. I'm thinking the way I think about investing, give me a broadly diversified approach to doing that. And I would probably feel that I'm taking a big step in the right direction of supporting the kinds of thinking that I might believe in. But I will tell you that my work is devoted, in terms of education, of trying to figure out how to get the best unit of return per unit of risk over the long term. And so I think this truly is for the people who this ESG commitment is real. And that suggests that you don't just have it for 10% of your portfolio. If you really believe that, why don't you have 100%? You can do it, just have to give up a little of that return from what we know about the past. There are four kind of major paths to how ESG investments and portfolios are built. The first one is like the Pioneer Fund. They didn't want the alcohol and tobacco and guns. And it really, exclusionary screening is normally about morality and ethics. And that really is not about trying to put together a portfolio of the highest profitability oriented investments. Then there are people who positively screen the best in all of the different classes. And so it is an attempt, and this is pretty much what the active management aspect of investing is about. Let me manage your money. I don't care if it's for the S&P 500, large cap blend companies, or it's small cap value companies or small cap growth. Let me try to pick the very best ones for you. There may be 500 companies in the S&P 500, but I would make the case, if I were trying to be your S&P 500 like advisor, let me get rid of the dogs and let me just give you the good ones that I think are going to make the most money. I said earlier, and I want to repeat, that the studies show that people who try to do that do not get, or the investors who invest with them do not get that premium for all that they paid to try to get. Doesn't mean the people who manage those funds didn't work their heart out trying to make that premium, but the research shows, the facts show, that that's a very difficult thing to do. But there are a lot of people who are doing that. We also have the folks who ESG is just a part, one of the factors that they include in the analysis. It is not necessarily the driving force behind the fund itself. And then, it's interesting where I heard Christine Benz speak was at the White Coat Investor Conference in Phoenix. And there were 600 physicians there, another 200 or 250 were online. And I found it fascinating because in my world, I'm a great fan of real estate investment trusts as just one of many equity asset classes that could be in a portfolio. But there, the interest amongst these people seemed to be more not in buying into a mutual fund that owns a bunch of companies that are in the real estate business, but investing in projects themselves, being part of the action, taking more risk. These impact investing, these are very specific projects where you might make a lot of money or you might lose all of your money, but they are individual projects that lack liquidity and not something that I'm in any position to recommend to you. So let's look at some of the biggest ESG funds that have been around. Some of them fairly recent, but some for a long time. Parnassus, Jensen, American Mutual, been around for a long time. I want you to notice a couple things about these three, because all three of them are actively managed. So they all have expense ratios. And the expense ratios run from 63 100ths of 1% to 82 100ths of 1%. And their returns have been pretty good over the last 15 years. Parnassus, 11.7. Now, I want to tell you something about Parnassus that's important. 15 years is not a very long period of time to judge performance, because something could happen in 15 years that is unusual, is something like, for example, we might ask, when you see better performance, were bigger companies doing better than small during that period? Were growth doing better than value? It turned out that growth was the powerhouse behind the market over that 15 years. And Parnassus is a 40 company portfolio of growth-oriented companies that qualify for their way of what is an ESG company. So it had a better return than American Mutual, which only got 8.7, but it had more value in the portfolio and smaller sized companies during this period of time. Now you go to a 15-year period where those things flip and smaller companies do better and value does better than growth. And this happens many times has happened many times over the last 100 years, flipping back and forth, and you may see that the American Mutual will do better. But as John Bogle said, returns are always different, but expense ratios are always the same. You have them for a lifetime. You can't get rid of them. They are a drag. And I only want to show you that between Parnassus, Jensen, and American Mutual, the actively managed funds, oh, and by the way, that active management leads to more taxes. So Morningstar, they do something I think real special in trying to help investors. They actually show you with any particular mutual fund how tax efficient has it been. And they look back at the last 3 years to make this judgment. And what we know is Parnassus, if you looked at their return over the last 3 years, you have to reduce it for taxes at a rate of 1.9% a year. Jensen, it was 1.6. American Mutual, it was 1.2. Now, these tax rates are based on the highest marginal tax rate. They had to pick some marginal tax rate in order to figure that out. But the active management, the turnover, the buying and the selling within these funds has caused the shareholders in a taxable account, doesn't matter in a tax deferred account, to make a lower rate of real return. On the other hand, look at these other two funds, the Vanguard FTSE Social Index and the iShares ESG Aware. These two have very low expense ratios. These are basically index funds. Now, sometimes we call mutual funds that have very little turnover passively managed. They may not actually follow exactly some index, but they act like an index in terms of the amount of turnover that they are exposed to. But what you'll notice here is, yes, they also lost a little bit to taxes, but it was what, a quarter what it was for these actively managed funds. So I'm not a big fan of actively managed funds. Not only are the expenses higher, but the tax implications are going to be reduce the return. And what is not reflected in the expense ratio and not reflected in that that difference in tax return is the cost of turnover. The commissions that are paid internally is not a part of this study of the costs here or here, either in the taxes or in the expense ratio. So what we have here then are some that are actively managed and some that are passively managed. And the Vanguard FTSE, the social index, has the 15-year track record was a compound rate of return of 10.4. It is not as heavily oriented to growth as Parnassus and Jensen, but they have 484 stocks instead of 40 or 28 or 175. And the iShares ESG fund has 317. And by the way, when you buy a mutual fund, and by the way, I should mention that this is the Vanguard FTSE Social Index Fund. That is a regular mutual fund. That is not an ETF. The iShares is an ETF, and it has tax advantages. And I want you to notice that over here on the far right, that UCG stands for unrealized capital gains, hidden inside of Parnassus. 21% of the value of the securities, 48% in the case of Jensen, 32% in the case of American, are gains that they have not yet taken in their portfolios. Notice with the ETF, zero unrealized capital gains on the books. It is the way that ETFs are managed compared to mutual funds, which is one big advantage. That is why I've got a friend that works at Vanguard. He's one of their advisors. And he said, we're trying to get all of our clients over into ETFs who are in taxable accounts. So who determines the ESG rating for the companies? Well, Morningstar, Bloomberg, and CSRHub.com here, Bloomberg.com. And I also included in here, this is a video, this YouTube piece made by the Morningstar rating organization. And I think you would find it very interesting. It is short, it is well done, and it will give you a kind of a better understanding of what goes into the thinking behind how highly rated should an ESG fund be.
If you're watching this after the presentation on YouTube, the link will be right down in the description box, so you can click on it right after Paul's done.
You know, that is great. And also, I know I provided a PDF of this presentation of the PowerPoint where I think those URLs are live as well.
Okay, we'll add that link as well.
That's great. Thank you very much, Reed. And then who rates the funds themselves? Where Morningstar is there. MSCI has both of those links will take you right to the sites, and they do a great job of explaining what it is they go through to determine who are the better ESG funds. Now, remember, they're not going to be judging the actual performance the same way that you would have that judgment being made if you weren't an ESG fund, because the highlight, the motive, the thing that is grabbing the attention of the investor, it is really, what do these companies represent to me that I am the owner? And when I teach young people, in fact, the presentation I'll make in this upcoming series at BCF, that is going to be for people 20 to 40. And I'm going to do my best to teach young people how I think investing really works. And one of my points to these young people is that you are truly building a business when you start investing. And you do have employees. You do have middle management. You do have upper management in the companies that you are putting into your business. And so this is certainly what is so important to people who invest in ESG funds. And if you want to see the range of recommendations you will get from the internet, just do a search. Do a search for best performing ESG funds and ETFs or anything like that, and you're going to get hundreds, thousands, maybe even tens of thousands, if you've got the time to spend it, of whether it's a Kiplinger's or Forbes or Fortune. I mean, all of these publications, and many that you've probably never heard of, are going to have their list of the best performing ESG funds. They do that to appeal to their readers and viewers. And what you will find, though, is very often you're going to find actively managed funds, funds that have a load to get into, and funds that certainly are not index funds. In fact, sometimes there won't be an index fund in the group. And that has to do with an editorial decision that is being made. And from my viewpoint, I should not be making decisions based on what I think will make people happy. I have just updated the annual series of our tables. Daryl Balls, our director of analytics, one of the volunteers, hundreds of hours every year for our nonprofit, just finished 198 updated tables through the end of last year. Those tables are built to help people find and understand the very best fund. So we're not doing things to make people happy. We're doing things in the hopes that will make people more productive. I do want to talk about one. There's actually two funds of this kind that if I had to pick a fund for sustainability or ESG, this is probably the fund I would pick. It is an ETF. There's a very similar fund created by Avantis. They're both very good. The reason I'm going to point to this one, to the dimensional ETF, because it's new, but it is built to look just like a fund that has been managed for 15 years. And it is the Dimensional U.S. Sustainability Core Fund. Now, that fund is a fund that is made up not just of large growth, but also has some exposure, enough to be meaningful, to mid and small. It is built to replicate the Russell 3000 index. And there actually is a fund managed by Vanguard. It is the Russell 3000 index, VRTTX, has an expense ratio of 0.08. Over the last 10 years, that's how long it's been available. It is compounded at 11.12%. The DFSIX, which is the dimensional fund that also is tracking, not exactly, it has 2,000 stocks, but and it's built of sustainable companies, and it over that period of time had an 11.34% compound rate of return. I will tell you that the actual index itself made 11.7%. So neither Vanguard nor DFA were able to make the same return as the exact index, but they came very close. And the important thing here is it did well during a period of time that small cap and mid cap and value, this has a fair amount of value in it. They may, I think, are going to make a difference in the long run. If I had to buy one fund that would be similar to owning a total market index, because it does have large cap, but it also has mid and small in a meaningful way, better than a total market index. I'll make that point for sure. Anyway, that is a fund I heartily recommend, and I have followed the dimensional work. That the reason you can't buy DFSIX yourself. You have to go through an advisor. That advisor may charge 0.5%, 1%, 1.5% for their services. You can go to this ETF, and by the way, get a more tax efficient fund than you would with the mutual fund. And here is the Avantis fund that I mentioned. It will have very similar returns as that DFA fund. And if you're interested in some international, both in emerging markets and in the larger cap markets, then that DFSI is these are all ETFs that are available on the market. And there are bond funds that are ESG driven. Now, I have included down here the bond funds that I use, that I consider to be as probably as ESG as is going to get, although you may disagree with me, but our portfolios are basically, particularly where we are in a tax deferred environment, we use short, intermediate, and tips to build our bond portfolios. But there are these other bond portfolios that are based on these ESG factors. Now, will ESG funds absolutely underperform conventional funds? We don't know. I can't know anything about the future. And here's just a couple of examples of how different relatively short periods of time can be. Here's stocks versus long-term bonds, the S&P 500 from 1980 to 1999. The S&P compounded at 17.9. That's quite a run. That's an amazing run. During that same time, bonds, 10.7, the long-term government bonds. But from 2000 to 2020. The stocks compounded the S&P at 6.6 and the bonds at 8.1. So I could say that stocks are going to outperform bonds. They normally do, and even for these long periods of time. But boy, not always. And so I can't tell you how ESG funds are going to perform. I do know it'll be based on how much they have at large and growth and value, et cetera. And I just threw this in too, just to show you that from 2000 to 2020, while small cap value compounded at 11.6, the S&P 500 at 6.6. But if you took and just look at the period from 2010 to 2020, it was 11% for a small cap value and 14 for the S&P 500. Nobody knows. But I do believe, and if you read this book, I am sure the library, I should have called. I'm sorry I didn't, but maybe you can even make a note in your write-up when you just to tell the folks, read whether this book is available at the library. But it is a terrific book. We actually had Larry Swedroe come and join us during an earlier educational series that we did with BCF. But I just want to share a few lessons from the book. One of the points that Larry makes is that he follows the academic research. And so often he'll be quoting some study that was done. But in this particular article or study from 2020 called Aggregate Confusion, he mentions the fact that people who rate ESG funds or stocks only agree about half of the time. So this is not necessarily a matter of facts. It is overlaid with some feelings. He also makes the point that if an investor has a lot of what he calls no-go areas in terms of investing, industries or stocks they do not want to hold, they've got to expect that regardless of what the long-term return might be, expect the short-term return to be different from the broader market, because the less diversification, the more you're going to have the performance differ. It doesn't track well when you don't have massive diversification. And that's okay. You may be fine for the long term, but be patient a short term. Number 3 here, economic theory suggests that if a large enough proportion of investors choose to favor companies with high sustainability ratings and avoid those with low sustainability ratings, the favored company shares will be elevated and the sin stock shares, what they call sin stock, will be depressed. And that happened. There was a period when there was just a huge amount of money that started coming into these ESG stocks and mutual funds. And it pushed the market for those stocks up to where then they are likely not to be as good a performers in the future. Remember back from 1995 to 1999, when the S&P 500 compounded at over 28% a year for 5 years. But then the next 10 years, it underperformed everybody else, and actually lost money on a compounded basis, about 1% over that following 10-year period. So there is the impact of having a whole bunch of money come at one time. One study showed that for the 115-year period from 1900 through 2014, tobacco companies, in terms of their return to shareholders, made a 4.5% higher annual return. So those people who could be bragging about having owned the healthcare sector fund at Fidelity or the software sector fund since 1981, they could likely be having that same kind of bragging rights for having owned tobacco companies. So there is and can be, will likely be, from everything the academics know about investing, will likely be better rates of return with the non-ESG. And one of the reasons that I am in favor of that fund from DFA and the fund from Avantis is because they are working to try to build a portfolio that will put enough of the mid and small size companies in there and value companies that still qualify to be ESG in order to bring their return up to be as close to the index for the total return that you'd have on a completely diversified portfolio. Also, he mentions that there is no evidence that active ESG investing does any better than passive. And in fact, because of taxes and because of lower expenses forever, lower taxes forever, those are big statements. And it is important to note that ESG strategies tend to be large cap quality strategies, high quality companies that are large companies. And what we know about those companies historically is they do make less because they are less risky. I can't let this opportunity go by. We have 2 free books. I'm thinking about your grandkids and your kids that might be interested in investing. The first one, we're talking millions. That book focuses on $12 million decisions that young investors make. Each of those 12, literally $1 million investment. And 2 Funds for Life is a book written by Chris Pedersen, our director of research, somebody else who volunteers hundreds of hours every year for our cause. This book, I think is a masterpiece because he is the one that created this 2 Funds for Life strategy, combining small cap value along with a target date fund. I think it is one of the most clever pieces of portfolio design that I've ever seen. So a big thank you, Reed, to you and to your organization. I get tempted to come down there and do some of that fun stuff that's going on down there at the senior center. I certainly qualify, and so I thank you for what you're doing for this community, and I'll certainly take questions. If not, you can email me at paul@paulmerriman.com, and I will get back to you. I promise.
Thank you, Paul. Yes, that very, very informative. And I know that I've been in meetings where board members and others have asked, shouldn't we be responsibly investing this money that we've been asked to husband? Yes. And so it becomes a challenge of asking what's good investing? Does it mean, as you said, your career has been focused on looking at long-term returns, which is looking just at basically the way that the analysis stacks up over time, which is that diversification and the variety of kinds of products, and then the idea of whether you're going to either have a moral decision or you're going to make a faith-based speculative judgment that the economy is going to benefit, it's going to move towards some of these things that are being listed in the ESG. And that's, as you said at the beginning, a faith-based decision, right?
Well, it is. And it's important to understand, Reed, that you're not going to have lower risk in terms of volatility. That's going to be basically the same. Small companies on a short-term basis are more volatile, mid-cap a little less, and then large cap even less on a day-by-day basis. But so that is not, it doesn't help that aspect. But day-to-day volatility is not what long-term investing is about. And the question, I guess, is, will you likely, as an organization, stay the course with what you have if you don't have this commitment to ESG? Because very often when you run into a period of underperformance in the market, people get antsy, and other salespeople come in and say, "Oh, you wanted to make more money. I'm sorry that you weren't working with me, because you would have done better. Let me show you what I do." And so there's change. And I will tell you, when I was on the board at BCF, the reason I went on the board personally was to convince the people on the board that they should be in index funds, not actively managed funds, in their endowments, in the money that they have, that they're managing for others. And I could see that while they were going with the idea of indexing, that they really felt good about the ESG aspect. And what the vibes I got from it was that these people, it's so important to them that I would make that compromise and say, okay, if that's how you feel, it's just as long as you use indexing and not active management, and get the massive diversity, the most diversification that you can. But it's a huge decision. Those brown companies that people don't want become cheaper. And the expectations when they become cheaper, that they're going to continue to be profitable. It's not like they're going to go out of business, but they're going to have to pay more, in essence, to borrow money, or they have to pay their investors more to get them to invest. And so the academics will tell you the brown companies are expected, because they've been pushed out of favor, to make more money. And guess what our friend Warren Buffett has focused on most of his career? Not bad companies, but companies that were not in favor at the time. And so do you give that up? Now, what you might, if there could be a compromise, if I was talking to your folks, I might say, well, if you really feel like you have to go all the way, go all the way. And probably the best I could recommend would be that fund, for example, from DFA, because it is a broadly diversified fund. It has 2,000 companies in it. It is all US, yes, but you can do the same thing internationally if you want to have international. And that would be the best shot. Or you could say, well, why don't we be half in the ESG, and the other half, let's take advantage of value issues, of more commonly diversified all comers who qualify as value, rather than just ESG. And those kinds of compromises can be found.
Great. Thank you very much. I appreciate your time. I don't see any questions in the chat, so I'll
Great.
let people email you. And we really appreciate you taking the time to put this together. It's definitely in the news these days. In fact, I know it was the subject of the president's veto pen this week, so it's timely anyway.
All right. Thank you. And keep up the good work at the center.
Thank you.